Flood violations are often something that can sneak up on financial institutions. Underlying risks are often not readily apparent until a triggering event occurs that makes everyone pay attention. For example, a change in the flood maps or a change in regulation, such as the regulatory changes with respect to private flood insurance, or a change in the way existing requirements are enforced, such as the requirement for contents coverage for commercial loans where the language in the mortgage or security agreement inadvertently took contents as collateral, even if that wasn't the institution's intention. With this in mind, a new flood risk has come to light. This risk involves cross-collateral clauses in mortgages and deeds of trust, and has recently been identified by examiners as causing loans to be underinsured as it relates to flood insurance. In the past, you may have been aware that cross-collateral agreements caused issues from a Regulation Z perspective as it relates to the borrower's right to rescind a loan. Cross-collateral clauses have not typically been associated with flood compliance risk. However, many of our clients are reporting that their examiners are questioning whether or not they have enough flood insurance for loans that are secured with deeds of trust or mortgages that contain cross-collateral or dragnet clauses. A cross-collateral or dragnet clause is one that states that a security agreement, such as a deed of trust or mortgage, in the context of real estate, not only secures the debt of the borrower for which it is granted, but also secures all other obligations, debts, and liabilities that the borrower may owe to the lender, regardless of whether it exists at the time of the security agreement or arises after it, and despite the fact that the other debt may be totally unrelated to the debt for which the security agreement was granted. In the event a cross-collateral clause exists in our security agreements or mortgages, how does this affect the flood insurance calculation? Well, as I'm sure financial institutions know by heart, for any loan secured by improved real estate, property, or mobile homes located in an area identified by the Federal Emergency Management Agency, or FEMA, as having flood hazards, the institution must require the borrower to obtain flood insurance in an amount that at least equals the lowest of the outstanding principal balance of the loan, the maximum amount available under the National Flood Insurance Program for the type of structure insured, or the insurable value of the property. Typically, it is relatively simple to determine the lowest of these three amounts, since all three are fairly clear with respect to any given loan. However, for a deed of trust or mortgage that contains a cross-collateral clause, the outstanding principal balance of the loan may not be limited only to the loan amount that is originated when the security interest is granted. Instead, it may also include any loans originated thereafter that are indirectly secured by the deed of trust or mortgage via the cross-collateral clause. Therefore, each time a loan is made to that borrower subsequent to the granting of a deed of trust or mortgage with a cross-collateral clause, the lender will need to reevaluate the flood insurance protecting the structures securing the debt if the insurance was previously written for the outstanding principal of the loan. Let's take a look at an example. Anytime you have a valid cross-collateralization, your loan amount for the purpose of calculating flood insurance is the combination of all loans that are cross-collateralized, regardless of any existing collateral for each individual loan. With this in mind, if you originate a loan on April 1st, 2022, we'll call this Loan 1, with a cross-collateralization clause for $100,000, with a security agreement in place for Property A, which is located in a special flood hazard area, and the insurable/replacement value of Property A is $150,000, and the National Flood Insurance Program maximum for the property is $500,000, the required minimum amount of flood insurance would be $100,000. Now, let's say a second loan on April 8th, 2022, we'll call this Loan 2, is originated to the same borrower the next week for $500,000, which is secured by Property B, which is not in a special flood hazard area, so flood insurance would not be required for this loan. However, because of the cross-collateralization clause, this loan is also secured by Property A, which is in a flood zone. As such, when Loan 2 is originated, a loan amount of Loan 2 of $500,000 would need to be included in the loan amount when calculating the minimum amount of flood insurance required for Loan 1 and Property A. As such, instead of a minimum amount of $100,000 in required flood insurance, this will now increase to $150,000, which was the replacement cost/insurable value of the property, because it is now the lesser of the three values used to calculate the minimum required amount of flood insurance. Now that we understand cross-collateral agreements and how these can impact flood insurance calculations, what should you do to determine the impact of cross-collateralization on your loan portfolio? First, either have your qualified internal compliance and/or legal experts or your external legal counsel review your current standard note, mortgage, or security agreement language to determine if any cross-collateralization language is included. Keep in mind that although this language is most likely to appear in commercial or business purpose mortgages or security agreements, this language could also be present in consumer purpose loans as well. If the cross-collateralization language exists in your current mortgages or security agreements, then you will need to determine the impact on your existing portfolio of loans, as well as come up with a plan for any new loans going forward. Next, for evaluating your existing portfolio, you will want to pull a report of all impacted loans that are currently being tracked as loans in a special flood hazard area. If you have made the determination that this language only exists in your commercial mortgages or security agreements, then this report should be targeted to the commercial loans where the collateral is located in a special flood hazard area. Be sure to check each loan and confirm that the cross-collateral language exists in all the loan documents. If cross-collateral language is present on your existing mortgages, you have a couple of risk-based options to ensure compliance with flood insurance requirements. First, you can choose to recalculate the amount of required flood insurance for all of the impacted loans. As noted previously, keep in mind if a cross-collateralization clause exists on the loan, your loan amount for the purpose of calculating flood insurance is the combination of all loans that are cross-collateralized. The second option is that you can modify or amend your impacted contracts, which would include your mortgage or security agreement, to either waive the cross-collateral clause entirely or provide a waiver in the event that flood insurance is required. If you choose this option, we strongly recommend that you work with legal counsel to ensure the waiver is sufficient, valid, and enforceable. Now, after discussing those options, what exactly do we mean by this being a risk-based decision? Well, regardless of the action that you choose to take, there will be risk involved. As such, you will want to consider the operational risks and impact if your staff members have to recalculate the amount of flood insurance, both for existing loans as well as for new loans going forward. Also, there is potential risk to customers that may be hit with an increase to the amount of flood insurance they will have to pay for, which could lead to possible complaints and/or reputational risks for the institution. This could result in forced placement if borrowers refuse to purchase sufficient insurance to cover the increase. And finally, there is potential for legal or regulatory risks if your action is deemed insufficient or a violation of law or regulatory requirements. For example, there could be impacts to your lien status in the event that you file a modification. Or you could have a regulatory violation if the amount of flood insurance is calculated incorrectly. After you have addressed any existing loans, you will want to consider how you wish to proceed with any new loans going forward. As previously noted, this may involve modifying the language in your mortgage or security agreements to remove or waive cross-collateral clauses when flood insurance is required. Or you may wish to move forward with the language in place. However, you will want to make sure that there are sound policies, processes, and written procedures in place to address the calculation of flood insurance in both origination and renewal in instances where a cross-collateralization clause is in effect. As previously noted, the mortgage or security agreement is a legal contract with your borrowers. As such, any changes or modifications should be discussed with your institution's legal counsel. Additionally, you may want to discuss any possible actions with your primary regulator to ensure they are on board with your plans. If you have any questions, please feel free to reach out to us if you would like to further discuss the impacts of cross-collateralization on flood insurance requirements.